Good afternoon, everyone, and thank you again for joining us for the fourth and last module with Professor David Gilchrist from Australia. Over to you, David.
Thank you very much, Natalie, and great to be here. And I can't believe we've been through 4 presentations already. The year is absolutely flying, and we were just talking about Christmas breaks and all sorts of things. So yeah, it's moving very, very quickly. But in this session, I'm hoping to clean up a few loose ends, if you like, in terms of this presentation, which has been focusing on, as a series, the not-for-profit balance sheet in a number of aspects, as you know. And so in this presentation, I want to start to look at some key elements around cash flow budgeting and also financial planning for the budget, for the balance sheet, but to also, to some degree, tie in the balance sheet with the other financial reports, as well as think more conceptually about how the balance sheet supports the decisions that you might make in the short, medium and longer terms. I'm going to speak for about 35-40 minutes, and then we'll have an opportunity for questions and comments. I'll be delighted to take those. The slides will be distributed at the end of the session as well, so you're very welcome to drop me an email if you have things that you think of after the session, which often happens, and I'd be very delighted to be able to respond to you. So I hope this turns out into a session that's useful to you, and I'm going to share my screen now just to start the process. I hope everyone can see that appropriately. So today we're looking at the 4th session, not-for-profit balance sheet, the cash flow budgeting and financial planning process. Before I get into that, I do want to first and foremost just simply acknowledge the First Nations people from New Zealand and also Australia, from the places where we're all sitting and hopefully enjoying this webinar, and to pay my respects to the elders past, present and emerging. I'd also like to just acknowledge that this seminar series has been based around the not-for-profit balance sheet, a resource put together by myself and Dane Etheridge in relation to trying to develop not only some information around not-for-profit balance sheets, but also supporting volunteer directors and others to be able to ask questions in relation to that. So this resource is certainly available. If you can't find it, please send me an email. I'll be delighted to send it to you. I think you'll find it's useful, and it's also universal. It's not Australia-centric. It will be useful to people in New Zealand as well, I'm sure. So as I mentioned before, the focus today is on cash flow budgeting and financial planning, looking at some of the aspects of building the balance sheet, if you like, in order to be able to ensure the ongoing sustainability of your organisation. And I'll touch base on what sustainability means shortly. But in the meantime, I guess the other thing I just want to say is that when we think about cash flow budgeting and financial planning for the balance sheet, really what we're doing is we're deliberately trying to structure the balance sheet for that sustainability going forward. And I guess to put it bluntly, that's really been the mantra of this series of seminars as well, is to be able to say to people, the balance sheet in not-for-profit and charity terms has always been an important document, but it's always run second, I think, to the profit and loss report. As funding arrangements change and as sustainability becomes more and more challenging for organisations, I think it's important that organisations take a much more proactive look at their balance sheet and look to structure the balance sheet accordingly. And so remembering the last presentation where we talked about asset replacement and decisions around asset replacement, and previous presentations when we looked at the components of the balance sheet and some of the potholes that you can hit in relation to not planning your balance sheet, there's a logical extension here where we're concerned about budgeting and financial planning to build the balance sheet for sustainability. And I guess the other element then, as I mentioned before, we need to remember our mantra in relation to what sustainability means for charitable and not-for-profit organisations. For commercial organisations, sustainability, I think it's fair to say, largely means the capacity of that organisation to survive and to continue to operate as a raison d'etre in its own purpose. Not-for-profits and charities really are organisations that are tools for their mission. And so sustainability goes far beyond the simple survivorship of the charitable or not-for-profit corporation. And so when I talk about sustainability today, as I have all the way through this seminar series, I'll be talking about the ongoing ability of organisations to be able to provide the right services in the right quantity, at the right quality, and at the right time. In other words, for us to consider sustainability for our organisations, we really need to ensure that we have sufficient cash and the appropriate asset mix, both very important balance sheet items, in order to be able to achieve that sustainability outcome for mission and not just simply survive as an organisation. I guess the other thing that I wanted to say then in that regard is that when we think about sufficient cash and appropriate asset mix, we talked about asset replacement last month, as you recall. To that extent, though, in terms of sufficient cash, managing the balance sheet and organising the balance sheet to be structured in the way that your organisation needs it to be is really fundamentally a cash flow process. And so managing your balance sheet, one of the golden rules is making sure that you're focused sufficiently on cash reserves and building the cash within your balance sheet. The second is to make sure that you are across the timing elements of the movement of medium and longer term assets and liabilities as they become cash. In other words, all assets and liabilities at some point in time either pay into the organisation or need to be paid for. And so there's two really important red flags here. One is, all the way through this presentation, you need to be thinking about the cash flow impacts that all of the things I'm talking about are going to have on your organisation. The second is the timing of those cash flow impacts. There's many organisations in commerce that have gone broke, notwithstanding they've had more assets and liabilities, but they've had a missed timing in terms of the realisation of those assets to the liabilities that are associated with their organisation. So sufficient cash and appropriate asset mix is a critical part of your design of your balance sheet and getting to a point where you feel strongly that your balance sheet is sustainable going forward. Okay, so what's the purpose of balance sheet budgeting then? Well, first and foremost, you'd probably say, well, David, you've just talked about cash flow and timing of that cash flow. And yes, that is a really important part of it. But also you need to remember that when we're talking about balance sheet budgeting, we're actually not talking about the profit and loss budget or the cash flow budget. We're actually talking about the cash components and the non-cash components and forecasting what they look like over the next 12 months, as well as into the financial planning period. And this is a really important issue, and I'll come back to this shortly, but the financial planning period, you'll recall from other presentations, is about 3 to 5 years. So we need to be thinking in balance sheet terms, what it's going to look like in 3 years, what it's going to look like in 5 years, and what kinds of implications that might have for our organisation sustainability going forward. We also, as I said, focused on targeting the balance sheet structure and not allowing the balance sheet to fall out of the budget process. In other words, we need to continue to ensure that that balance sheet process, budgeting process, is part of our ongoing forecasting process. And this is, I think, fair to say, very unusual for not-for-profits and charitable organisations. It's certainly my experience, both in Australia and New Zealand and in other countries, has been that organisations are very, very strong and adept at budgeting their profit and loss, budgeting their operational cycle, if you like, but not necessarily budgeting the balance sheet. And in fact, it's only relatively recently that organisations have taken up that particular aspect of governance for their organisation. To that extent, perhaps one of the first questions that directors need to ask their CEOs, CFOs, or others within the operations of their organisation is, how are they budgeting their balance sheet, and how are they making assumptions about how those balance sheets might be forecasted to turn out over the next 3 to 5 years. The balance sheet, of course, is focused on the short, medium and longer term horizons, and I will speak to that a little bit more. Suffice to say, my horizon always is that 3 to 5 year financial planning horizon that we talked about. And then, of course, the element of the financial plan is that the budget for the balance sheet needs to consider sustainability in the terms that I've identified, but also needs to support the strategic objectives of the organisation. So while We always budget to sustainability, that is being able to present those services in the timing, quantity and quality that's required, and to maintain the capacity to do that is really important, but also to make sure that the balance sheet has sufficient assets and capacity to support growth and change in the organisation over time, which is absolutely critical, as well as supporting those strategic directions that the board might establish. Again, we'll talk to that a little bit more shortly, but suffice to say at this stage of the game, there's probably three things that we talk about when we are concerned about financial planning for the budget then. The first one is that sustainability. The second one is that continuing capacity to provide services over the medium and longer term. And the third is how we're going to replace assets and deal with those asset processes. That third one we dealt with in the last presentation, you'll recall, but I'm happy to touch on that in relation to questions, if any should come up. Okay, so in terms of the elements of the balance sheet and balance sheet budgeting, we have here the same element that we've introduced each month as we've gone through this presentation, looking at the short, medium and longer term elements of solvency, sustainability and sustainability into the longer term. In terms of solvency, we know that cash flow and working capital is absolutely critical, and we will talk about that shortly. We also know that in the midterm, we need to be able to pay things like leave entitlements, and we need to be able to also cover off our depreciation. Ultimately, we need to be able to recover our depreciation on our assets. You'll recall from the last presentation that depreciation is the accounting estimate for the consumption of those assets over time, not a process of putting money aside. And it's certainly not an accounting function that doesn't mean anything from a sustainability perspective. We really need to come to grips with what depreciation estimates are for our organisation. And then in the longer term, that asset replacement issue that we dealt with in the last presentation. So today we'll look at cash flow and working capital, and we'll look at some of the other components of planning components, but in the context of financial plans. And I guess in that respect, I'd like to just show this slide to be able to show you the three components of the financial plan development and how it should work in your organisation. The financial plan is not a set and forget document. You don't just create it today for 3 or 5 year horizon, but you actually come back and continually review that in the context of new experience, new learnings about what might happen, and better forecasting as the time period for the forecast reduces as time elapses. And so to that extent, obviously the annual development of things like the operating budget, the cash flow budget and the capital budget are all informing the budgeted balance sheet for that year. But then the ongoing development of things like the asset reinvestment plan that we discussed last time, but also forecasting employee entitlement payment estimates and loan capital repayments and things like that, allows us to look at the ongoing financial requirements of the organisation from years 2 through to year 5. And the annual update of that financial plan, I think, is absolutely critical. As I said before, we need to keep revisiting that in order to be able to apply the learnings and the experience that we've got from time to time. So what does all of that mean? I think it means that there's some key questions that we need to be asking of ourselves and our organisations. First and foremost, it won't surprise anyone to hear me say that we need to be asking whether or not we will have sufficient cash to maintain solvency throughout our financial planning period. This is relatively easy to forecast over the coming 12 months, but as time goes out or extends rather into the medium and longer term, it becomes a much more fraught process to be able to be to feel comfortable in terms of your accuracy of those kinds of forecasts. Again, this is why we have to keep reforecasting, and perhaps going back to the previous slide, looking at those components of financial plans, you might want to look at the financial planning outcome twice a year rather than at the end of each year or during the budgeting period for each year. In other words, it might be worthwhile just looking at that financial plan outcome over 3 to 5 years on a 6-monthly basis rather than annually, as we tend to do with our annual budget. That process, certainly in the middle of the year, will inform the annual budget, but it'll also give you confidence about the efficacy of the financial plan, whether or not you think it's going to actually turn out the way you expect it to. Secondly, the will we have sufficient cash to invest in change and replace assets? I think this is a really important issue, and certainly the Australian experience with the implementation of things like the National Disability Insurance Scheme and also our aged care system, where client choice and control has been much more focused on and much more a part of the design of the system. A big sustainability threat loomed for not-for-profits and charities delivering services in those areas. And that threat wasn't in relation to the replacement of assets, but rather it was in relation to being able to invest for change management and to be able to invest, to be able to work out what the model of operation should be going forward in order to fulfill the government funding and policy requirements as they were set. In other words, we often think about balance sheet management in the context of asset replacement, and that's really important. But we don't often think that we need to put sums aside in order to re-engineer the business itself and to manage change processes and perhaps even provide training or develop other resources, including information technology resources, to be able to operate as environments change. And that's, again, in the Australian context, the experience here has been very much that these changes have come along and really impacted the sector quite substantially, because the sector simply hasn't had the resources to be able to implement change that they need to implement. So will we have sufficient cash to invest in change and replace assets? I think are two really important questions to be asking there. Will we be able to meet all obligations in the short, medium and longer term? I don't think that is a particularly insightful question to be asking, given all of the statements I've made up to this point in time today. But at the end of the day, I think it's important to be able to categorise those commitments in the short, medium and longer term as well, to understand what it is you're actually talking about. Things like employee liabilities, of course, are important, but there might be other issues, for instance, in relation to the ongoing accreditation of facilities or of courses or of services you provide, and what you might need to do to maintain that accreditation could be part of that obligation in the short, medium and longer term. And also, are we adding landmines to the balance sheet is a really interesting question to be thinking about as well. What do I mean there? Well, I mean that what often has happened in the charitable and not-for-profit sector, and I have to say it happens in commerce as well, is that we tend to have a focus on the profit and loss and on the cash flow in the immediate sense, because of course we want to be solvent, and often we don't necessarily understand what the funding arrangements or other things are going to turn out like in the medium or longer term. And that's fine, but it does mean that often organisations allow landmines to develop in the balance sheet because you're not balancing, you're not managing that balance sheet as well as you could. For instance, allowing employee entitlements to build up and not pay out annual leave or long service leave, or to allow for assets to fall in valuation and perhaps get closer and closer to replacement without really considering how you're going to react to that when those assets no longer are valuable to your organisation or supporting your organisation to be sustainable. Because remember, sustainability is not just about being able to have the cash to do what you need to do. It's also about having the asset mix that's necessary. Pardon me. So are we adding landmines to the balance sheet is an important consideration. Pardon me, that might also have some policy implications. For instance, in relation to employee entitlements, you might have to have a policy where you have expectations of employees to take their leave when it becomes accrued to them, rather than allowing it to push on for year after year, or there might be special requirements for approval and so on. There might also be policy implications, as we discussed last month, in relation to asset replacement, particularly those assets that, if they don't work, might result in some clinical or occupational health and safety outcome that's negative to the organisation. So what are the elements then of balance sheet budgeting, the things that we need to take into consideration? In a sense, this particular slide, I think, probably draws together all of the strings, all of the things that we've been talking about over this series of seminars, I think into a neat package to give people a focus point for that balance sheet budgeting process going forward. In the first instance, the short-term elements relating to profit working capital budgeting and also cash flow budgeting, and we'll come back to those things in a second. In the medium term, we're worried about employee entitlements budgeting, so leave forecasting, and loan repayment capacities, so capital repayment schedules, for instance. But that could also include leases for assets and lease payout requirements, so balloon requirements in the case of some leases. And it could also include repayments or payments for sinking funds or other arrangements, other financial arrangements that might be needed. The other thing that you might think here and you might make a note of is in relation to short and medium term elements, increasingly governments are requiring your organisation to be able to provide services and then invoice after the fact rather than being funded in advance. And this can also have implications in the case that, again, in the Australian experience at the moment, in terms of care workers, the ability to hire care workers is very, very low. It's a very difficult thing to get people to be able to work for you, in which case there is a great difficulty in delivering services, in which case there's a great difficulty in actually achieving the income that you need to achieve. And so solvency and other issues creep in. And so it's important to think more laterally than just simply in terms of profit and loss and cash flow, in terms of the changes that might be coming down the pipeline that might impact not only your ability to pay your bills, but your ability to actually operate as an organisation and therefore to be able to invoice your funder clients. In the longer term, we're concerned about things like asset valuation, asset replacement, things that we talked about last month, but also that business continuity and restructuring, so the investment capacity. And I know I've emphasised this a few times, but I think it's a really important point to think about. Often governments, and I'm sure it happens in New Zealand as it does in Australia and it does around the world, often governments change policy and the rhetorical arrangements around that policy without thinking through what the impacts are going to be for the supply side, for the organisations that actually deliver. And so that what business continuity and that restructuring capacity, being able to understand your business and being able to invest to change your business model is a really important element. Let's have a look at profit, because I don't think we've talked about profit a great deal over the last few presentations. And that's a critical part of the process because it actually is the point of building the balance sheet. It's where we actually build the wealth of the organisation. First and foremost, I'd like to just make a couple of comments around the use of the term profit itself. In a lot of Anglophone countries, so in countries where English is spoken, charities and not-for-profit organisations tend to be lumped together and told that they can't make a profit. They need to talk in terms of surpluses and deficits rather than profits and losses. And I understand why that is. There's a history to that, a baggage, if you like, that comes with that. But it's actually not a good thing for the sector to be talking about. And I think that's for two reasons. The first reason is that when organisations make a profit, they feel that their philanthropic supporters and government supporters might question the allocation of resources to them because they're obviously a profitable organisation. And this has certainly been the context in Australia, where we've undertaken research and identified that one of the biggest things that charities and not-for-profit organisations are concerned about is returning a large profit and being penalised by those funders accordingly. And so, notwithstanding though, we need to change that rhetoric or that discussion, because profit's absolutely critical to any organisation operating in a mixed economy. New Zealand and Australia have mixed economies, and that means that your organisations have to make a profit in order to be sustainable in the short, medium and longer term. There's no other way around it. And so I do think here, if I'm allowed to get on my soapbox for a second, it's really important for the sector to be continually talking and describing to all of the stakeholders, philanthropists, governments, commentators, people like myself that talk a lot about the sector, that the idea of making a profit is not only legitimate, it's critical for survival and critical for building those capacities in the balance sheet. So to that extent, I think that surplus really is not describing what it is you're trying to do. It's not extra cash that you've got that you don't need, and that's the communication that surplus provides to people. Rather, profit is a financial gain. It is allowing you to be able to build your balance sheet, because you're building the wealth of the organisation. Let's have a little bit more of a discussion about profit. So, as I said before, in order to be sustainable, it must make a profit, but that profit must be after depreciation. Organisations must be working towards being creating a profit that actually delivers a greater amount of money to the organisation ultimately than the expenses, including depreciation. Depreciation is that estimate of consumption, as I said before. If you don't cover your depreciation costs, you're not actually making a profit as an organisation, because you're not actually building the capacity of the balance sheet to be able to make the investments that I talked about earlier. The comprehensive cost of services needs to be covered, that is, including a profit margin for your organisation. And I'll speak to the issue of what a profit margin might look like shortly, because that is a really difficult issue for not-for-profits and charities to be able to forecast, compared to commerce, where banks and others all have industry and market expectations placed on them in terms of what that return should be. And so it's relatively easy for them to be able to say what their profit margin target is, whereas for not-for-profits charities, I think it is difficult. You need to, though, in all of these things, and including in relation to making a profit, communicate to your rationale for that profit to the financial stakeholders that you might have in your organisation, to members and others. In other words, I think it's absolutely critical to surround all of this, including the financial planning process of the next 3 to 5 years, with commentary that actually provides the rationale for what you're doing and gives people confidence that not only are you building the wealth of your organisation, there's a rationale or a purpose to that, and you've actually demonstrated that, which will give them greater confidence to support your organisation, rather than simply making assumptions that because you've got cash or because you're making a profit, you don't need the support that they would normally give. So I guess there's a really important issue here. Profit builds the organisation's balance sheet. Without profit, you can't build the balance sheet, you can't make the reserves and do the other things that you need to do. Now, it's true to say that organisations might get philanthropic or other donations to be able to support those things, and that should be part of your financial planning as well. In other words, where does the money come from to do some of the things that you want to do? But you really need to be thinking about profit and working towards that process. So there's a couple of questions that come with that, though, as I'm sure that's already in your mind. The first one is, and I can hear you say, well, that's great, David, but we don't get a lot of funding from government, and we're working as hard as we can in an environment where demand seems to be going up and up and up, and where our capacity to deliver is substantial, is substantially impacted, not only by the lack of money, but also by the lack of staffing, by the lack of sheer capacity to be able to meet this growing demand. And that's true. So all of the things that I've said up to this point, I think stand and are true. But I think you also have to have, pardon me, a process where you accept that in the financial planning process, you're identifying the profit that you want as an organisation or that you need, but you're also identifying in that process what we might call the profit target gap. And so what I am saying to you is, number one, all of those things that I've said up to this point, I think are true, and I believe that they're critical. But number two, any rational, experienced person in this sector would understand that it's not just as easy as David saying, go and make a profit. You've actually got to think about how that's going to work, and also accept the constraints on organisations in undertaking those processes for all the reasons I just outlined. So this idea of profit target gap is a really important one for those charged with governance, CEOs, CFOs, and others within your organisation, to be able to say, okay, this is the profit that we'd ideally want. This is the real profit that we can make. Therefore, this is the financial planning target or financial planning gap that we have going forward to support our sustainability. In other words, and it's easy for me to say, I get this, so there might be some questions or comments, and I'll be delighted to correspond on this topic as well. But at the end of the day, you might construct a financial plan that says you need to replace all your assets in 3 years, and that might be $1 million, and I'm just making things up, obviously. If you're not making sufficient profits to be able to set aside $1 million over that 3-year period, then you need to be able to identify where those funds are coming from elsewhere, which might mean that you need to go to a philanthropist. It might mean that you need to go to government. It might mean that you need to even think about your service mix and whether or not you're going to be able to afford those asset replacements, and whether what you do today is what you're going to be doing 3 or 5 years' time. That's what the profit target gap helps us to do. It helps us to identify where those deficiencies in finance are in order to plan to rectify those deficiencies, rather than, probably, if I'm absolutely honest, I think a lot of charities and not-for-profits either don't engage with that element and so don't recognise that there are potholes in the road coming up in those time periods, or even if they do know that they're coming up, often their attention is so focused on the present that they effectively put their heads in the sand, because it's very difficult to think beyond what you're trying to do at this point in time. And those are very real challenges, there's no doubt about that. But I do think at the end of the day, having an understanding of what your ideal profit might be, what your actual profit is, and what the gap is, gives you the ability to identify you need certain resources at certain times, but also gives you the ability to advocate for more resources, particularly if you're a government funded agency. So what are some of the key questions? One is, well, what is our achieved profit and what does history tell us? In other words, when we're forecasting profit, we need to be based in history. What should our profit target be, or what should we be aiming for? And I think that's pretty straightforward. How do we communicate with stakeholders about profit? So remembering in all of these stages, we need to tell the story in order to continue to maintain the support that we want to achieve. And we also need to think about what I term consolidated versus program or service profit budgets. At the end of the day, in my view, charities and not-for-profit organisations probably should have a mix of profitable programs and services, and programs and services that might not deliver financial returns but are really germane and critical to the mission of the organisation. It might be because no one else does those services because they're not profitable. It might be because they are extra or holistic elements of services that round out your paid for services, such as socialisation programs or those kinds of things, where you're actually paying to deliver those services. What I'm saying here is that I'm not one of those accountants that says, well, no, you should only undertake profitable programs and services. What I am saying, though, is that you should be intellectually aware of the impact of those services that you're providing that don't have a profit attached to them, and have a plan of attack in terms of approaching those, so that the organisation overall is actually making a profit, even though some parts of the organisation or offerings of the organisation might actually cost you. Just one sideline there is that increasingly organisations are understanding, intellectually engaging with those programs that they think from a mission perspective they have to continue to provide, but which cost them money. And the way they're approaching that is to simply deliver a profit in year one, and to then allocate parts of that profit to those social programs, if you like, in year two. So in other words, save up and spend the money rather than spend the money and then try and work out where it's going to come from to balance the books, if you like. So what about profit target? This is a really important issue. Profit target is really the margin. So the actual margin achieved minus the target margin is the target margin gap, or the profit gap that I talked about before. And I think that's pretty straightforward, but happy to talk about that. In that regard, what are the examples, or how do we know what that target margin should be? And one example might be, for instance, industry CPI. So what are the cost changes that are associated with the industry that you're involved in? For instance, again, I keep picking on Australia, but the Australian Bureau of Statistics develops what we call health CPI each year. So most people would be aware of CPI, the Consumer Price Index, which is the basket of goods that is costed each year by national statistical agencies in order to work out what the cost of living is. So what are the basket of goods that everyone needs to have in order to be able to live day to day in their house? The health CPI is that basket of goods that allows hospitals and others to deliver health services. And having an understanding of the industry CPI is really important. So again, to pick on Australia, over the last few years, CPI has run at 1.1, 1.2, 1.3%. Health CPI has run at 4.1, 4.2, 4.3%. In other words, getting the basket of goods right and understanding what those cost increases have been are really important. If you're not achieving at least your industry CPI, then you're not standing still, you're not building your balance sheet. So you need to think about that. To be practical though, in Australia, only about 20% of charitable human service organisations meet the industry CPI. So there's a real deficit there. You can use for-profit comparators as well. And in a number of human services, as we know, there's mixed not-for-profit and for-profit providers. And for-profit providers have to make a profit. So that's a yardstick for your organisation to be able to estimate what profit might look like. But also your financial plan needs would inform profit as well. So being able to say this is the cash that we need at certain points in time means that cash has to be generated, which means that a profit needs to be generated to achieve that outcome. Things like asset replacement, change management, service design, staff development are all parts of that particular process. The gap itself then, we need to have obviously a strategy for closing that profit target gap. And that strategy could be capital injected by philanthropists or others. It could be processes and philanthropic programs that you put in place to be able to raise funds to replace assets and so on. It could be, though, prioritisation of mission versus profit is a big issue that you need to think about. So I spoke before about those organisations that have unprofitable programs that they think are important from a mission perspective, and you have to have that. But you also have to have balance between mission and profit. Only your organisation can work out what that balance should be for you, but your financial plan should help to inform that in terms of what those priorities might be. You need to be able to demonstrate that gap by in order to build advocacy as well. So in the case of organisations that are funded by government, I think it's critical for those organisations to be able to demonstrate the solvency and unsustainability impacts of not having a profit going forward is going to have. So the capacity to charge is also a really important issue as well. What can you do to be able to cover that gap? Are there opportunities for you to charge elsewise? So subsidising government procured service delivery is absolutely critical in this critical consideration here. What often happens in the Anglophone world is that governments understand that not-for-profits and charities will continue to do the work, and they basically use the goodwill of those organisations to deliver services much more cheaply than government would deliver it. And I think subsidising and hiding that lack of profitability has not worked in the sector's favour, because I think it reinforces this idea that government can simply rely on the sector to continue to deliver. Again, really happy to talk about that idea too in a few minutes' time. So profit impact has free cash flow. It's that balance sheet build I said before, appropriate pricing, better budgeting. It allows you to budget more effectively going forward. But there are those negative stakeholder consequences I mentioned, which means you have to have a communication strategy around that budget build. Now, just very quickly, I just wanted to look at the short, medium and long-term components, and then we'll finish up with some questions and comments. So in terms of working capital budget, I think this is a really important element to think about because the working capital budget is what actually allows your organisation to keep your doors open, having cash there to pay bills before your invoices are paid. Again, in the Australian experience, we're increasingly seeing government take longer and longer to pay invoices, and the working capital component for organisations is increasing quite exponentially. Without profit, it's very hard to build that working capital base. So I think this is a really important issue. In that regard, how do we govern this? Well, I think we have working capital and other ratios, and I'll speak to ratios very quickly just shortly, but also thinking about how we might reduce the working capital cycle in order to be able to ensure that we have the least possible investment in that working capital process. Medium terms, we need to have that target cash level. So what are our reserve requirements? And we spoke about that last month, but things like cash backing employee entitlement. So there's cash there for those employees when you actually come to pay it. A leave forecasting is a critical part of that, but also putting aside provisions for reinvestment and asset replacement. As long as these things are tagged, so to speak, in your financial report and communicated effectively to stakeholders, I think these cash levels or reserves are really important elements in your strategy to maintain solvency and sustainability going forward. Profitability, that margin achievement is absolutely critical. But remembering incremental reserve building, we need to be building reserves every day, not just worrying about those reserves requirements in 3 years or 5 years' time. And also we need to have a governance focus on that. So making sure that there are appropriate questions asked and reported on at board meetings to support that confidence that the board has in terms of building your balance sheet. In the longer term, that asset mix requirement is absolutely critical. We need to think about the regulatory requirements, so accreditation for buildings or other resources that we might be applying, any changing technology impacts, which are quite substantial. Not only is the technology changing, but also the cost structures are moving to subscriptions, as many of us know, and that's having a significant impact on operational capacity as well. And also changing consumer demand as consumers become more and more aware of what they want and how they work, how they should receive services, quality and other requirements go up accordingly. And that ongoing sustainability requirement is actually critical. So forecasting timing is critical here, and depreciation. And again, we talked about that last month in relation to this particular chart. And I won't look at it or talk to it deeply because we are running out of time, but that chart is a critical element in terms of your planning for asset replacement and some of the policy frameworks that will support you to make those decisions. Okay, so what about reporting and balance sheet budgeting? From a governance perspective, obviously you've got to have some key reporting processes to be able to support directors to have the confidence that they need, but also to report to stakeholders on an annual basis that you're achieving the outcomes that you want to achieve. So you might have a set of primary targets in terms of things like cash capacity, for instance, minimum balance targets. Often organisations report things like number of days of operation in cash reserves. Ratio targets, and I'll talk about ratios you'll be excited to hear in a minute, but also net asset targets. So what's the net asset wealth of the organisation that you're targeting, as opposed to just simply the profit target or the P&L target that is traditionally used for governance in these areas. The other types of targets you might have include what we call facilitative targets. So you might have targets for philanthropic donations that are really important as part of your financial planning process over time, building up to be able to do the things that you need to do, for instance, in relation to asset replacement. You might have lottery system applications, so where you've got the ability to go to lottery systems or to others to be able to apply for funding might be part of those facilitative targets as well. But your profit target is also a facilitative target. So you want to be able to make that profit, but you also want to be able to ensure that profit results in cash that goes to the balance sheet. And then finally, that net cash flow target, it's a fairly obvious one, but it's often still not reported by charities and not-for-profits on a regular basis. You need to know what your net cash flow target is and to report against that target on a regular basis. Now, the final thing that I wanted to say is that while there's all of these targets and things that I'm talking about that you should consider, ratios are often a very good way of being able to assess and manage this process from a governance perspective. Ratios are good because they compare multiple elements. They compare the relationships of numbers and allow you to be able to both use your traditional accounting ratios, and I'll talk about one of those in a second, but you might also have ad hoc ratios that are relevant to your organisation. For instance, you might have philanthropic dollars to income. You might want to have a certain proportion of your income focused on philanthropic sources, for instance. But ratios are arbitrary. They are only designed to point to things that you might investigate. They're not outcomes in themselves. So a failure to achieve a particular ratio target might mean that your organisation needs to do a deep dive in that particular area to see what's going on and see whether there's actually a problem there. So this is a governance focus and a forecasting focus. So one of the things I guess I'm saying out of all of this is that when we're doing that forecasting, we use the forecast as part of the governance tools to be able to support the organisation into the future. And as I said before, this can support really directional analysis. In other words, ratios can help us focus on those things that we think are important. For instance, the working capital ratio is current assets over current liabilities. Different organisations might have different versions of this particular ratio, but this is what I would call a traditional accounting ratio. And when we're thinking about that working capital ratio, we need to think about all the good things like debtors collection time, the cash balance that we're after, the uninvoiced income that we might have entitlement to, and in the cases of those organisations that sell things, what the stock turnover is. In other words, to be able to develop that working capital ratio, we also need to understand how long it takes our debtors to pay and how quickly we can get them to pay. So how we can shorten that particular period, how we can invoice any income that we're entitled to on a more quick basis, and how we can get that stock turned over. On the current liability side, of course, there's all of these things as well. Creditors, payments, employment entitlements, unearned income, all things that we want to reduce, but we also want to pay in current terms, particularly in relation to employee entitlements, which, as you know, the longer they go on, the longer they stay on the books, the more they cost the organisation, because you've got to pay in future dollars, not in current dollar values. And therefore, if pay rises occur, those people essentially cost you more for that particular element. So we need to think about ratios, not only in the context of what they actually report, but more deeply about what the components of those ratios are and how we might be able to use them to ensure that we're meeting the financial plan that we're looking to meet. Sure, a few minutes over on that one, but really happy to take questions or comments. Natalie, if there's anything to talk about.
Thank you very much, David, for that. I haven't seen any questions in the chat, but people might just process all the information that you've shared with us. So if anyone's got any questions, feel free to unmute yourself or pop a question in the chat. No, you must have been very clear, David.
Must have been very clear. It's actually quite a difficult set of subjects because there's a lot of things you've got to think about. I'm really happy, as I said before, once you've absorbed it and thought it through for your organisation, drop me a line. I'd be happy to answer any questions or comment if you think that would be useful, of course.
That is very generous of you, David. Thank you very much. And
not at all.
I think that might be the way to go because I don't see anyone unmuting themselves or posting a question in the chat box. So thank you everyone for thank you very much, David.
Thank you. Have a great Christmas, everybody, and hopefully we'll see you in 2022.
Yes, thanks everyone for joining us for those series. As promised, you will receive the slides afterwards. There's also the link to the recording, so if you want to watch it again, and if you've got any questions, feel free to take David up on his generous offer. I'll put his contact details in the email as well. Thanks everyone.